Steve Perl, PMF Bancorp. So for the last 23 years, I've been in commercial lending. You probably see me as a suit. Well, normally I don't wear something so formal. So, today I'm on the camera, so you know what? I put on a tie. But if you come to the offices in Century City, it's much more relaxed, so you don't have to sweat it. My topic today, of course, is an extension of the whole subject matter, alternative financing solutions for small businesses. And what I wanted to do is there's a lot of information here, so don't panic if you miss some stuff. I'm going to stay around, and of course, you can always call me. So my bio and background is, like I said, been around LA, financing for about 24, 23 years, and always in commercial lending and helping to focus on small and medium-sized businesses. What does that mean? Businesses that are doing maybe as low as $500,000 a month to about $50 million a year. And so, and sorry, I misspoke there. $500,000 a year to $50 million a year. So PMF Bancorp's a U.S. Leading lender in commercial finance. We've been dealing with clients in that size, in that realm that I just discussed about since '85. We have offices in the U.S. and in China, and I'm often there, and that's the trade finance and export piece that I'll talk a little bit about later. Being in clean tech, you may be buying equipment or something. We can talk about that a little bit more as we progress, especially at the end if you have questions. Today we're going to focus on fintech, and we're going to focus on traditional loans, invoice factoring, and trade financing. And trade financing, I want you to think of synonymously with PO financing and import financing, any kind of financing that you have a supplier involved. So fintechs are really small business loans. So you really have to demystify when they say fintech and technology and all this, it's nothing more than a loan you're applying online for. That's all. So you typically in the past, you went to a B of A or some other company, a big bank, and you took an SBA loan out and you applied. They have a single page app and you apply. But there's a lot of parameters. And the fintech made it easier because they integrated the process of approval quickly online, and they also made it a little less conservative, which the traditional banks require a few other things. So what are we going to talk about real quick? Does your business industry qualify? What are the parameters of a fintech loan, and how do you qualify for that financing? So who are the people that typically, what are the companies that qualify? Online businesses, wholesaler, importers, service industries, software, logistics, most companies. The ones that don't really qualify are construction, medical, financial, insurance, real estate. These are the ones that won't qualify for a fintech or a small loan. Typically, your fintech parameters are similar to a business credit card. Remember, there's nothing special about a fintech. It's a loan you apply online. You're really going to be looking at anywhere from $20,000 to $100,000. There are some fintech people that say they'll give you more. I'll save you a lot of time on where to go. There's a lot of predatory lending out there, and in defense of the industry, and I don't really specialize in this, I'm talking about it now. You're risky, and so 1/3 of these loans typically go bad. So if they don't charge higher rates, this product wouldn't be a economical product. It wouldn't have an ROI for the lender. So you have to look for the best in the industry, and typically they want to give you a loan from 6 to 18 months. The rates can go anywhere from 8 to 39+%. And so you really have to be careful, especially with the fees. Now, I can save you, like I said, a lot of time, probably, and I'm going to do a plug for them. I don't work for them. I'm not a part of them. I don't even know anybody there. But I've seen the rates over many years, and for example, Cabbage, I've seen them do pretty decent rates. I'm going to say 12, 14%. You can get a 24-month, 12-month loan. Now, it sounds terrible, but the reality is even an on-deck that says they're so friendly is like at 30, 39%, and they want you to pay back in 9 months, and they have all kinds of fees which add up and create an amortization that's terrible for a typical business. So we got to keep rushing through it. The good thing about these loans is if you really need the money, $100,000 to create that new product, and you pay $30,000 or $25,000 for the money that year, well, that's a hurdle. That's the cost of doing business. You don't want to keep at that level. You want to move up the tiers in financing, but it may be suitable to move down to create your value of your business or your enterprise value. And that's what you have to keep the eye on. So how do you qualify for a fintech loan? What do? They usually take 10% of your sales, and they say if you're doing $1 million, they can easily qualify you for a $100,000 loan. The beauty of it is they only need monthly bank statements and a few other parameters like decent credit score. So I'd advise you now to work on your credit score, because everybody along the food chain is going to want to see that you're a decent person from a character perspective. Do you pay back your credit cards? Do you pay back? Because if you can't do that simply, then obviously the bigger loans are going to say, well, if there's an issue, you're probably not going to pay back me. So you really have to think about that. I'm just going to skip over some of this stuff because we need to keep moving, because there's a lot of slides, and you can ask me later, like I've said. How to qualify for a larger business loan, I'm not even going to talk about that, but I wanted to say versus a fintech loan, it's very different. And I think Amanda touched upon it. These are tier 1, tier 2 kind of companies that require financials, 3-4 years of profitability, a track record on a product. They want to see a sales cycle. They want to see a structure, a corporate structure. They want to also see tax returns. I mean, this is a lot more than a fintech that requires 3 or 4 bank statements and a good FICO score. You can go to our website if you want more information on that. But could your business, and this is a question, could your business benefit from $100,000 in working capital to launch a product or a new program or buy a little more inventory? If it is, and it really creates a difference in the ROI, or large difference, or your enterprise value, which might not equate to an immediate return on investment, but if it does, maybe this is something for you. So what is factoring invoice financing, and how does it, how do you qualify? What are the parameters? And what is it? So many people may have a glimpse that factoring invoices is the conversion of simply your invoices into cash. So it's a form of finance, but it's a nice form of finance in the fact that it doesn't create debt on your books. It just takes a current asset in one column, which is your invoices, and transfers it to another current asset, cash. So it's very nice in that sense, and it can be pretty economical sometimes and quick for liquidity. So what are the companies that use it? A wide range. Manufacturers, wholesalers, software companies, service, they all use it. The key is, and I'll go into what's qualifying you for it, is you have to have invoices. The people that typically don't use it or have a hard time qualifying are, again, the usual suspects: construction, medical, real estate. So what are the parameters of invoice factoring for a typical deal? $20,000 to $2 million is a typical range. Now, of course, you'll have some larger factors that do $20 million a month. Well, this is not what we're talking about. Your range is typically in here. Most companies are in that range. So let's talk about that. Their typical tenor is 12 to 24-month contract. You can get people that say no contract, but remember, it comes with strings. They're going to charge you more. It's not a relationship. It's a very transactional kind of experience. It's not the kind of supportive growth structure that you want for a growing company. You do want to get a good company, and typically you will have to get into a short-term contract of some type. But remember, your company needs a year to 2 years, maybe 3, to get to the next tier. So it doesn't really matter anyways, realistically speaking. The rates, typically 6 to 12% a year on average, but you'll have a fee on the invoice typically. The nice thing about factoring is there's no loan payment. You don't have to worry about a monthly loan. All you do is worry about the invoice paying, and that's a self-liquidating loan. You take an advance against your invoices, it turns into cash, you forget about it. You don't worry about it because the factor or the finance company will collect and get paid back and give you the difference, which is they don't usually give you the full amount. They give you 80% typically. So how do you qualify for this? Like I said, you have to have invoices, or AR, accounts receivable. Your business has to sell on terms. You typically have terms of 90, 60, 30 days, something like that. If you don't have terms and you have invoices, but they pay quickly, well, it's not something you want to use, right? Because why spend the money on the expense of financing if you're going to get paid in 3 days? So the question here, ask yourself, maybe if you qualify, or this is a good thing for you, do you have receivables, of course? Does your customer take too long to pay? And do you not have enough cash to grow or pay payroll on a timely basis to grow the company? The next item is PO, trade, and import-export financing. And the PO and trade financing and import financing are really synonymous. It's the financing of a supplier. Now, export financing is really you're financing a customer on an export. You're selling to somebody abroad. That's a little bit different. We'll talk about that. But PO financing, trade financing, and import financing, these are some things we specialize in. That's why we have offices in China. It helps a lot of our clients that we have offices throughout China and Hong Kong, because a lot of times they're sourcing from those areas. And for example, I have a company that manufactures pallets that I finance. I mean, we finance software companies, we finance service, we finance staffing, we finance almost everybody. But these guys happen to manufacture pallets out in Fontana. Well, they need nails, and their nail supplier is charging them a ton. And so they've asked me in the offices on a project to source them some product and finance it. So we found them nails, believe it or not. It sounds mundane, but this is important to a pallet company that manufactures. So how do you qualify for this PO and trade finance stuff? Well, what industries are best suited? Wholesalers and importers are great, and exporters. These are great companies, targets for this. What are the parameters for PO trade finance? Well, typically they're loans between $25,000 and $2 million. Now, this is, remember, you're buying stuff from suppliers. It's purchase order financing. You get a purchase order from Walmart for widgets, and guess what? And if you don't make the widgets here, you're going to buy them from somebody, maybe a guy in Fontana, maybe a guy in China. One way or another, you may need financing to buy those goods. And so that's what this financing is for. Typically, this financing will cost you 3 to 8%. It's not cheap, but if you have a decent margin, it can work. And if you don't have the capital and you have the purchase order, well, is it better not to make the sale? Well, I would argue if you make a little money, you've created enterprise value for your company by creating a sales revenue, an annual sales revenue. Staying theoretical forever is great, but most companies, unless you're Elon Musk, are not going to be able to raise money theoretically. How to qualify for PO trade financing? Well, you have to have experience, of course, and that's what they really look for. Of course, you have to have accounting and sales cycles to show that this is a mature process. Some companies will potentially give an advanced management team financing right off the bat because of their management expertise and experience in related companies. But normally, if you don't have experience like that, you're not going to be able to come to a factoring or a finance company and say, I have a PO and can you finance me? It typically won't work because it's really an execution, and we can talk about that later, but bankers understand that, and it's not so much the brilliance of the idea, it's how good the people are at executing their stuff. We really don't finance brilliant people most of the time. I mean, just to be quite blunt, people are smart and they have good execution skills, and that's what gets them the loan. You know, common sense, realistically. Qualifying for export financing. Now, this is just a quick item, but foreign aspects become very important when you're financing a customer abroad. For example, how are you going to underwrite the customer's credit? That's the first thing a lender is going to really look at and want to understand. Do you have credit insurance? Are these people on an Ex-Im Bank CLS, which is the client limitation schedule. And so, there's also the OFAC schedule. And so these are all kinds of things that you're going to have to become familiar with if you start selling abroad. You can email me. I can explain more later. We don't have enough time. But PMF Bancorp is also a certified Ex-Im Bank lender. So we have a lot of experience in these areas of financing imports and exports. So a polling question here would be, do your customers with large orders have seasonal large orders? Do you need more money for production that's domestic or foreign? In these cases, you might be qualified or suitable for PO financing. To be qualified, of course, we have to look at those other parameters. Now, we've just talked about fintech, glossed it over, factoring invoices, glossed it over, and PO financing and trade export financing, we've glossed that a bit over. But what are all these things? How do we tie all these things in? The elephant in the room here is the credit of your buyers. All of these forms of financing will come back to who you are selling and what the credit of your buyers are. And so that's where we come in. We have a lot of experience with that. Banks won't help you with that. Commercial finance companies like us that provide this lending service and specialize in just lending, we do help our clients with that because we know that's a very important piece. The banks will expect you have your act together already and your clients are A-rated, and when their underwriters get done, if it isn't, then the loan just doesn't get qualified. They don't bother talking to you about it. So with the understanding that credit's important, I wanted just to throw this out there. We think making and giving our clients better ability to make credit decisions is very important. So we created a credit app. So the credit app allows you to run free business credit reports through us. Instead of paying Experian, $100 a report, we can send those Experian reports to you if you need it. And you can leave your card with me if you want someone in the office to follow up with our software if you do have a need to run credit on potential customers, because it's definitely a value. So if there's anything else, and this we usually reserve for clients and friends, but since you guys are here today and I'm speaking, I'm happy to help. And if there's any questions, I'm happy to answer a few questions. I know I went really fast, and I'll be here afterwards too.
Howdy. So you talked about a bunch of different products. My question is it a viable strategy to perhaps start out with something like the fintech loan, which it sounded like it was very expensive, and use that to get yourself running, and towards the end of the term, go ahead and kind of restructure the debt in like the large business loan, which is cheaper, and then kind of roll into the the other product, which was at I think 6 to 12%, and then eventually go into investors. So basically just keep refinancing to cheaper money.
Yes, I deal with a lot of startups and a lot of mature companies. And honestly, we also do some investment in some of our companies as well. And so it's always good to have a little bit of equity to start off at the beginning, because if you start off swimming and you're just swimming without sales and you just have this loan over your head based on your own personal credit, you really have to be careful. And so starting with a little angel investor or a little of your own money is much more advisable. And as soon as you catch your wind and get a PO and a little bit of sales, jump into, and it really depends on your business plan. If your business plan is, you have to remember these loans, these tiered loans I'm talking about, I'm not giving you the contextual timeline. They typically take 24 months to 3 years to move from tier to tier. It's not like next month or next 12 months, I'm going to be in second tier. And 12 months after that, I'm going to be a first tier. It's impossible to be in first tier in 24 months because most of the traditional banks want 3 years of profitability and tax returns. So at some 5. So, you're not going to be able to make that business plan work if you're paying high interest before the sales are coming. And depending on the sales return and your strategy, there's a lot of moving components there. So it's hard to answer, but my gut feeling would be not to take it right away and make sure you have sales initially before you start with that.